Hi, did you know that you can have three times to four times return on your investment for the same trade which you would have taken on equity? Well, this is called as margin trade. So if you want to understand how the margin trades work, go through the video in the following few minutes and you will get a clear idea and understanding how you can have 3x to 4x returns on your trades in the stock market. This is Paresh Desai from Sankalp Venture, and let us understand how you can make 3x to 4x on your investment on the same trade which you'll be doing on equity. Now, today we'll be talking about the concept of margin trade. So, what do you mean by margin trade? We have heard about normal trading, where in the normal trading we find that you would buy a share for a particular value, and when it goes up, you're going to sell it, okay, and then pocketing the difference amount as a profit. So, I'm going to give you a classic example where you have bought ICICI Bank when it had given you a buy signal, let's say somewhere around 9:34 or 9:35. Over here, and the date would be somewhere around 30th November or so. It had given you a buy signal where you would buy, and then within a few days, what happened was that this stock went up to almost like 1040 and giving a return of almost 10%. Now, how much time did it take? It is around 15 days because if you see the date here, it is around 15th of December. Now, these are called as positional trades. Okay. So there are two types of things which you can do in the market. One, you can be an investor. One, you can be a trader. In trader, again, there are two types of traders. One would be a short-term trader, and another would be somebody called as an intraday trader. Means for an intraday trader, you'd buy in the morning or sell before the market finishes, or something also which is possible in intraday trading is called as shorting. So you short the market in the morning, and towards the end of the market, you again cover your position back. So these are the two types of trades which a person can do. Now, the one which I showed you for ICICI Bank was not an intraday trade. It was over a period of 15 days. And in a period of 15 days, we saw that you got a return of around 10% or 11%. Now, if somebody says, Paresh, can I have a little bit more? I would say yes, definitely. Why not? Because as the dil mange more, that is every time whenever we get something, you always why not something more? Okay. Now, if you want something more and you have something called as margin trade, that is what I'm going to explain to you today. What do you mean by margin trade? So instead of 10%, your return can be three times or four times. So instead of 10%, if I say 3x or 4x, it can go to 30% or 40% for the same amount of investment. For this, I'm going into my Demat account, which is of HDFC Securities. And if I try to put here ICICI Bank, and ICICI Bank, let us say I want to buy a quantity of let's say 1,000. If I want to invest something like 50,000 rupees, I will buy something like 50 shares. Okay. And you have to select the exchanger, National Stock Exchange, NSE, and this is around buying price is around 990. So I'll buy 991.15. This is the value I'm going to put. Now, over here, if I say know your margin, okay, the margin over here, this I've selected for something called as an E margin. Okay, so this is not a normal trade. In this trade, what happens is you are going to take extra leverage from the broker, and for getting that extra leverage, what you require to do is need to pay an interest on that extra amount. It is like let's say you want to buy a car of 20 lakh rupees, but you don't have 20 lakh rupees. You have got only 4 lakh rupees. Then you approach the bank and say, see, I've got 20% to put as a down payment. Will you finance me for the balance 80%? If the bank says yes, we are more than happy. Okay, we'll give you a loan, and on that loan, you pay us interest. So how does that happen? You pay like 4 lakh rupees and you get home a car worth 20 lakhs. So similarly here also, you can pay an X amount Okay, but you get a benefit of 3 times or 4 times. So that's what I'm going to explain you here in this E margin. In the E margin, let us say I want to buy 50 shares, right? So margin right now, can you see what is this? It is showing around 12,400. Now, for 50 shares into 991, it would have easily gone to around something like 50,000. But what is the amount which I require? It is just 12,500. Look at this amount. It is just 12,500. So 12,500. So I am getting something worth 50,000 and only 12,500 rupees. Okay. So for that, I need to pay a brokerage of around 351. So for the same concept, now I'm going to show that how this is going to be effective and worth taking the margin trade, even though sometimes the margin, the brokerage may be high, or you also might have to pay some interest on this. Now you'll say, okay, Paresh, if this is the case, if I have to pay interest, interest would be very high. Interest is the normal interest what the banks would be lending you, and it is somewhere in the range of around 14 to 15% per annum. Means on an annual basis, it will be around 14%. So let me see, I'm going to put here and find out how much would it take. We saw that I wanted to have 50 shares. Okay, I'm simplifying it. I'm rounding it off the figures a little bit here. 50 shares into amount is I'm taking it instead of 991, I'm taking it as 1,000. Now, since I'm taking a trade on the E margin, I don't require to pay 50,000 rupees. I just need to have a margin of 12,500. That is what we saw over here. Since it's a margin trade, you don't pay 50,000 rupees. You pay only rupees 12,500. Now, this becomes your investment. Okay, this becomes your investment. Now, there are other costs for this. Now, let us say that you got 10% on this. Now, similarly, how you got from 940 to 1,040. And if the value goes up from 1,000 rupees to 1,100, you will get something like 10%. Okay. So if price moves up to rupees 1,100, okay, you get 10% return, right, on your investment. Assuming goes up in the last case, what we saw, it went up in 15 days, but I'm not taking 15 days. I'm taking a more conservative approach that goes up in 1 month. Okay. It takes 1 month for the price to go up from 1,000 to 1,100. Okay. Now, what is your benefit? So what is the profit? The profit for you is going to be, in this case, you have got 50 shares into 100 rupees, which you earned, which was your rupees 5,000, right? Now look at the fun. Now look at the fun part. Now, what is an investment? Investment is not rupees 50,000. Investment is rupees only 12,500, because that is the amount which you're giving as your margin. Okay, so investment is your 12,500. Okay, but now there is another cost. So what is that cost? Less your brokerage. So brokerage, I'm taking around 350 rupees, less interest. Now, how much is the interest for 1 month? Let us calculate. So how much money is used by you in this process? The money used, you're taking a exposure of 50,000. Your own money is of around 12,500. So the difference, 37,500, is the amount on which you are going to pay the interest. Okay. So interest calculation will be like this. So on 37,500 into 14%, okay, 14 divided by 100 into, again, what, 1 divided by, to just 437. I will round it up to 450 rupees. Okay, so your net profit 5,000 minus 350 minus 450. So 350 is a brokerage, 450 is the amount of interest which you paid. So 5,000 minus 800 becomes 4,200. Okay. So now let us calculate what is your ROI. So your return on investment becomes 4,200 divided by 12,500 into 100. It comes to around 34%. So what would have given you a return of 10% is now coming to around 34%. Okay, so that is more than around 3.5x. I hope you understood how the calculation is. Let me just summarize one more time. So what happens is that you buy shares worth X amount. Let's say you want to buy 50 shares for 50,000, but you don't pay 50,000 rupees. You only use a margin of around 12,500. If the price moves up by 10%, you can use the calculation for different percentages as per your calculation and also as per the time limit. The profit is going to be how much? 50 into 100, which is going to be 5,000 if the price moves up by 10%. Now, where did I get 50 and where did I get 100 from? 50 is the number of shares and 100 is the total profit. Okay, so if the price moves up from 1,000 to 1,100, the profit is going to become 100 rupees. So 100 into 50, you get a profit of around 5,000 rupees. Investment is not 50,000. Investment is just 12,500 less your brokerage of 350, less your interest of around 450. So 5,000 minus 350 minus 450 would give you around 4,200 net amount. So that is your return on investment. Instead of 10%, you're getting a return on investment of around 34%. Okay, so I hope you understood how the calculation for the margin trades has to be done and also how you can take advantage of the market moves and get more from your money because after all, ye dil mange more. So if you like this video, don't forget to subscribe to this channel. Once again, this is Paresh Desai from Sankar Pedi Venture. I hope you have understood and also you're going to take advantage of this. So see you soon in the next video. Bye.